Every real estate investor eventually faces the same gut punch. You built something, you sold it, and then the government handed you a bill you didn't see coming. What if the strategy you chose on day one was quietly deciding how much of your profit you'd actually get to keep? Let's talk about the exit, because most people obsess over the buy and completely sleepwalk into the sell. The tax hit at disposition isn't just a line item. It can erase years of compounding if you haven't engineered your position from the start. The biggest culprit is capital gains tax. And if you've held a property for less than a year, the IRS treats that profit like ordinary income, which means it gets stacked on top of everything else you already earned. Hold longer than 12 months, and you drop into long-term capital gains rates, which for most investors lands somewhere between 0 and 20% depending on your bracket. But here's where it gets interesting and a little absurd, because depreciation, the thing that saves you money every single year you hold the asset, actually comes back to bite you at sale through something called depreciation recapture. The IRS taxes that recaptured amount at 25%, which means the deduction that felt like a gift was really just a loan with a balloon payment at the end. Now, the strategy that has made more real estate investors wealthy on paper and in the bank is the 1031 exchange, a section of the tax code that lets you defer capital gains indefinitely by rolling your proceeds into a like-kind property. The catch is that you have 45 days to identify a replacement property and 180 days to close, which under pressure feels less like a tax break and more like a timed obstacle course. Think of the 1031 like a game of hot potato. The tax liability never disappears. It just keeps moving forward in time, growing larger but perpetually deferred until the day you decide to cash out completely. And here's the part most people don't say out loud. If you never sell and pass the property to your heirs, the basis steps up at death, and that entire deferred gain can legally vanish. That step up in basis at death is genuinely one of the most powerful and quietly underused wealth transfer tools in the entire tax code. And yet most investors discover it too late or not at all. It sounds morbid, but structuring your real estate around a long hold, never sell, pass it down philosophy is not pessimism, it's generational arithmetic. On the opposite end of the spectrum, opportunity zone investments offer capital gains, deferral, and even partial elimination if you hold for long enough, and they were designed specifically to attract patient capital into underserved markets. The irony is that the neighborhoods flagged as opportunity zones are often the exact ones that were systematically underinvested for decades. So you're essentially getting a tax incentive to do what good investors were already quietly doing. A lot of investors get paralyzed by these structures because they feel complicated, but the misconception is that you need to be a hedge fund to access them. You don't. A straightforward 1031, executed with a qualified intermediary and a clear reinvestment thesis, is available to anyone who owns investment property and has the discipline to not touch the proceeds. The lesson history keeps teaching, from the tax shelter days of the 1970s to the depreciation abuse crackdowns of 1986, is that strategies built entirely around tax avoidance without underlying asset quality eventually collapse. The best tax strategy is also the best investment strategy. Buy cash flowing assets, hold them long enough for appreciation to compound, structure ownership intelligently, and let time do the heavy lifting. Practically speaking, that means choosing your entity structure before you buy, not after, because an LLC taxes a partnership, an S-Corp, or a DST all carry different exit implications. It also means working with a CPA who specializes in real estate, not just a generalist who files your W-2 every April, because the nuance between active and passive income classification alone can swing your tax bill by tens of thousands. Position sizing matters here too, because the investor who over-concentrates in one property and needs to sell for liquidity is always at the mercy of the tax calendar, while the investor with a diversified portfolio can afford to be strategic about which asset they liquidate and when. Discipline at the portfolio level gives you optionality at the exit, and optionality is where the real leverage lives. At the end of the day, minimizing tax pain in real estate isn't about finding loopholes. It's about playing the long game with intention, structure, and patience baked in from the very first purchase. The investors who keep the most aren't necessarily the ones who earn the most. They're the ones who plan the exit before they ever sign the entry. You don't have to be a tax genius to get this right. You just have to stop treating the exit like an afterthought and start treating it like a strategy. Whatever the market does, whatever rates do, the investors who stay rational, stay structured, and stay patient are the ones who wake up wealthy instead of surprised. And if you're ready to stop leaving money on the table and actually build a real estate portfolio with the exit already in mind, check out our links in the description below. Whether you need help with real estate investing, contracting work, or finding the right lenders, we can help you get started.